In this video, I'm going to teach you about a great tax planning strategy called the buy, borrow, die strategy. You may have heard of this strategy before because a few years ago, there was a big news article that came out that said it was exposing the way that the wealthiest billionaires in this country avoid paying tax. But in reality, anyone can use this strategy. I've used it personally for a number of years, and when I used to have a consulting firm, I worked with my clients to implement this strategy as well. In this video, I'm going to teach you what the buy, borrow, die strategy is, show you how it works in practice, and also teach you how you can use this strategy as well. So let's go ahead and get started with what is the buy, borrow, die strategy. So the strategy is really simple if you understand some basic tax consequences. But essentially what you do is you create this wheel for your assets or your investments or your businesses, anything that you're investing in, you want to put in this wheel and implement this strategy so that you never have to pay tax or you avoid paying as little tax as you can. So the way it starts is with the first step. It's easy. Go out and buy an asset. So for example, this asset could be Apple shares. So I'm going to use the example of buying Apple shares throughout this video to help show you how this can work in practice, but it can really be any asset. It could be real estate. It could be a business. It could be anything that's a true asset itself. So you buy the asset, step one, that's easy. I think we all can understand that. Step two, this is where it gets a little bit more tricky, but you never sell that asset. That's the whole point of this circle, is that you're going to buy an asset and you're going to never sell that asset again. So you need to, if you're going to put your investments in this circle, you need to understand that you should only really apply this to, for the most part, assets that you're never intending to sell. So that's why Apple shares, for example, might be a good example, but it can be anything like a closely held family business or a real estate property that you think will be, a great investment and cash flow into perpetuity. So think about this strategy when you're trying to understand it as if I'm buying assets today that I'm never going to sell. I'm going to pass those assets down to my kids and so forth. And these are really long-term investments. So the reason why that's important is because when we get to step two, which is borrow, that is going to be how we access liquidity against that asset. It's going to provide a number of different benefits. But instead of ever selling that asset, let's say I want to cash out my investment in Apple shares, or let's say I need some money to invest in something else or to buy something else. Instead of selling that asset, I'm going to borrow against it. And I'm going to teach you a little bit more later about how exactly you do that. But just keep in mind that what's important with this strategy is that you're buying an asset and you're not selling it. And instead of selling it, to access the liquidity or to kind of diversify or take out some of the value of the appreciation in that asset in the future, we're going to borrow against it in some form. And the leverage that we use is going to depend on the type of asset we're talking about. But that's step two, is that when I need liquidity or I want to diversify or somehow cash out, I'm going to borrow. I'm not going to sell. And I'll talk more about why you don't sell, but essentially, to just make sure we all understand what we're doing here. When you sell an asset, you pay tax. When you borrow against an asset, you don't pay any tax of that. You actually get a tax benefit from that, which I'll teach you more about. But we want to avoid taxable realization events. That's the whole point of this strategy, is we're buying assets. Those assets are appreciating in value. We're not going to pay tax on it. We're going to keep earning returns on those assets. And then we get to step three, which I know we don't like to talk about, but we all know, unfortunately, we are going to die at some point. So step three, and why this is on here and why this is important, is that under current law, when you die, your heirs get a step up in basis in that asset. So what does that mean? So basis is very important from a tax standpoint, because if I buy an asset, which I'll talk about this a little bit more when we run through an example with numbers, but when I buy an asset, let's say I go out and buy one share of Apple for $100. My basis in that share is what I paid for it. So it's $100. So if I turn around and sell that share immediately for $100, I don't have a taxable gain, because what I paid for it is basically what I got back. So there is no gain there to tax. So the problem with that is that I buy a share of Apple, now, and maybe I paid $100 for it, but hopefully whatever that investment is, if it's not Apple shares, whatever it is, hopefully if I look 5, 10, 15 years down the line, that should have probably doubled or tripled in value at a minimum. And so I've got this huge gain embedded in that asset. So maybe, that share of Apple, when I look 20 years down the road, is worth $500. Well, if I go to sell it, I get $500, but I only paid $100 for it. So I've got a $400 taxable gain. And that we'll talk about tax rates, but at a minimum, you're paying 24% federal on that. And so that is going to eat into your returns in a huge way. So you don't want to pay tax if you don't have to, and certainly not at a rate of 24%, and that's just federal. We're not even talking about state yet. So why is dying owning that asset better? Well, let's say instead of selling that asset 20 years down the road when that Apple share is worth $500, I die and that gets passed on to my kids. So what happens when we die is this beautiful thing. The only good thing about death is that we, from a tax standpoint, get to pass that asset down at the fair market value basis on the date of death. So if I die in year 20, the cost basis for tax purposes that my children are going to take in that asset is not 100. It's not what my basis was. It's the basis on the day I died. So it's 500. So what happens is that from an income tax perspective, my children get this $500 share of Apple. They can turn around and sell that day for $500 and pay zero tax. So they got to inherit a fair market value step up in basis. So that's what we call step up. You're stepping up the basis in the asset to what the fair market value of that asset is on the day you die. So this is a phenomenal tax planning tool. This is how some of the wealthiest families in this country have passed down generations and generations of wealth without paying any tax, because of that beautiful tax planning opportunity that we get, where we get to step up the basis. So when I say step up basis in the asset, that's what I mean. It's important that you understand that, because if you don't understand that, you won't understand one of the most critical steps to the buy, borrow, die strategy. So just to kind of recap, it's very simple. We buy an asset. We never sell that asset. When we need, or if we need to access some sort of cash or some sort of liquidity with respect to that asset, we don't sell it. We borrow against it. And then we die and our heirs get a step up in basis and asset. So that in and of itself, that is the buy, borrow, die strategy. It's not any more complicated than that. So if you can understand that, then those kind of 3 steps and why they work the way they do and what we're trying to accomplish there, then you've got it. And so now that we understand what the strategy is, let me walk you through kind of an example with some numbers. I know I've talked about the Apple shares, so let's just stick with that example. Keep in mind, it doesn't have to be Apple. It could be any publicly traded stock. It could be real estate. Again, it could be your business. It could be any asset that you can potentially invest in. So just so you can see the numbers and how this would work in practice, year 1, I go out and I buy 1 Apple share for $100. So on that day, my basis is $100. If I turn around and sell that Apple share for some reason, my basis is the same as what I would get for the Apple share. So I have a 0 tax gain there. So it doesn't matter what the tax rate is, because I don't have any gain. So there's no tax there to pay on that. But you also didn't get anything. So that's not, a great result. So let's say year 5, I've got this Apple share. It's doubled in value. That's great. And I think, okay, I want to take advantage of the fact that I've made these huge returns on my Apple share. And maybe I want to, invest in something else. Maybe I'm happy to keep $100 in the Apple share, but I'd like to take that other 100 and invest it in buying a real estate property or some other uncorrelated asset to start diversifying. Well, what happens is if I go and sell that share, and this is what most people do because they don't know there's this strategy, like your financial advisor will go out and sell shares all the time. If you look at your 1099, you'll see that financial advisors are always making trades every year. So they don't understand the strategy, and they're certainly not doing it for you. So it's definitely something you need to understand. But if I go and I want to somehow just access the benefit of that appreciation in that Apple share, if I go out and sell it for $200, then I get $200, but my basis is only $100. So I have $100 taxable gain. And so I've got to pay tax on that. So and keep in mind in this example, I'm only talking about federal taxes. It's 20% long-term capital gains tax. So if you held the stock or asset for over a year, you should get 20% rate under current law. And there's this extra 3.8% Obamacare. It's called net investment income tax that applies. So don't forget about that. So your effective federal rate should, depending on, it should be close to 23.8%. And add on top of that any state tax that you owe. So you could be looking more in, low 30s to higher if you live in a state like mine, like New York City or New York, you pay city tax as well. So it really gets bad if you live in a state like New York and in New York City, or if you live somewhere like California, you can really see these tax rates go up a lot. So in this example, I'm assuming just federal tax. So I've got to pay $24 of tax on that gain. So that means even though my Apple shares were $200, I only get in my pocket $176. So in my mind, that's a really bad result, because I could have gotten to, I could have still had the benefit of the Apple share and recognized the appreciation without having to pay tax if I put this into the buy, borrow, die strategy. So why is this bad? So it's not, and again, keep in mind the buy, borrow, die strategy is not just a tax play. There are other benefits here, but one of the main benefits is that we're avoiding paying tax on the asset. But I'm going to talk about that there are some other benefits that do apply here. So it's important that you understand those as well. So what are some of the benefits, or in this case, what are some of the problems here is that I no longer own that Apple share. So I don't get any future appreciation in Apple. So, that investment was great for me for 5 years, but maybe I wanted to keep it in perpetuity and, see what Apple does in 20 years and 30 years and 50 years. But I no longer get that. So if Apple goes up a lot, then, I lose out on any future appreciation. So that's a negative if you sell the share. Also, obviously, if you sell the share, you pay tax on the gain. And as we saw in this example, you're paying $24 of tax, so you're only getting $176 that you actually cash out from the asset. So that's, again, a bad result. Another reason why you might not want to sell the share or might want to not do this way is that you're not getting diversification of your assets. So a little bit later, I'm going to talk to you about why the buy, borrow, die strategy can be a great tool to help you diversify your assets without having to recognize some of the other negatives, such as, losing out on future appreciation of one asset as opposed to another, and also having to pay tax. So this is just a real life example of how this can work. And so this is assuming you didn't do buy, borrow, die strategy. You didn't know about it. You just went out and sold the share. So this is what most people do that don't understand tax planning. So now let's talk about how this would work if instead of doing this way, we did the buy, borrow, die strategy. So again, we're going to put it into the wheel. So step one, I buy one Apple share. So that's easy. Go out in the market, buy one share of Apple. Step two, instead of selling that share in year 5 or whenever, when I want to recognize the appreciation that Apple shares had, I'm going to take a portfolio line of credit against that share. So this is basically, I'm borrowing against my Apple share. There, you can call this a number of things. It can be a portfolio line of credit. It can be called a securities-based line of credit or an SB lock. Sometimes it's called margin lending, but keep in mind with margin lending, people often think you're talking about buying shares on margin where you don't actually have the money, but you can buy it, basically borrow to buy it. I don't do that. I think that's very risky. That's not what I'm talking about here. I'm talking about a margin loan where I've got one share of Apple in my brokerage account and I take a loan against that share. So it's important that you make that distinction. We are not talking about a situation where you go out and buy Apple shares where you don't have the money and you're just, taking a margin loan. That's not something that I do, and not something I would ever recommend anyone do. But here we're talking about just taking an asset-based loan. So, and you can do this, you can do this through your brokerage account. You can do this through, the most common way is like I have a couple of brokerage accounts and I shop around for the best rates. So right now, interest rates aren't great as at the time I'm recording this video, but they're still a heck of a lot better than what you're going to get out there in the market on other assets. But I use a brokerage called Interactive Brokers, and I'll link to them in the bottom. But they, in my experience, have the most competitive rate. If you see something that's better than them, then let me know. I'm always, open to what the best rates are out there. But this is much better than what you're going to get usually at Schwab, Vanguard, anywhere like that. They're going to have much higher rates. So I recommend shop around for the best rates here and make sure that you're paying as little interest as possible on that. So what I do is I've got my one Apple share. I've got it in my Interactive Broker, IBKR brokerage account, and I take a loan against that. And I do that instead of selling. So I instead of selling my shares, I just take a loan against my share, with the share itself being the collateral for that loan. So that's what I'm calling portfolio line of credit. Again, that can have a number of different names, but essentially we're just borrowing against our public stocks in that brokerage account. And then I don't ever sell that share. So when I die and pass that share on to my heirs, they're going to get a step up in basis in the asset. So they no longer have any gain at that point, and they can turn around and sell the share as they please. And also, I can do whatever I want with that money I borrow. Like, the bank's not, you don't go through what you typically go through when you're lending and taking out like a mortgage or something. They don't really care what I'm using the money for, but you have to be smart. I'll talk a little bit about the risk and how this can go wrong. You definitely have to know what you're doing here. But again, I don't have to explain to them what I'm using. I can invest in another asset. I can use it to pay my personal expenses, and it's my money. I can do whatever I want with it. So let's go through some of the benefits and why doing this way instead of doing it in the previous example where we sold the shares is better. So I still own those Apple shares. I still own the stock. So I'm able to get the future appreciation Apple. And again, you don't want to make investments in things you don't think are going to increase. So assuming you're doing that right and your investments are still, gaining and appreciating over time, then you're still getting that appreciation in that asset. I'm not paying tax on the gain. So I still own the asset. I cashed out on it to some extent. I'm not paying any tax on it. And I can diversify my assets. And this is where I'm going to pause and talk about the way I use the buy, borrow, die strategy. So when I say diversify assets is I might want to invest in something else. So I do this quite frequently in my personal investing. So I like to invest in a lot of syndications or funds, mostly real estate, focused funds or syndications. In some cases, they're PE funds or those types of alternative investments. So what I commonly do is I also have a brokerage account. And what I'll do is I'll borrow against my brokerage account, and I'll take that money and invest that in a real estate fund. So you want to do this in a way that's uncorrelated. You don't want to be like, I wouldn't borrow against Apple and invest in more Apple. Like that would just be really bad, I think, from an investment strategy, and wouldn't make a lot of sense. But what you can do, in the way this strategy is used a lot by really savvy investors, is that you start to diversify your assets by borrowing against one and investing in others. So, and I'll talk a little bit more about how this is even better, especially when you get into the context of where you own a business or build a business and that starts to get really big. But I might have a bunch of Apple shares that are appreciated in value, but then Apple shares might be a huge part of my net worth percentage. So it might make sense and be a good strategy for me to start borrowing against that to invest in uncorrelated things like real estate, private equity funds, venture capital, whatever is your, investments that you like. It's a really great tool to start diversifying your assets. It also, as you can imagine, allows you to double your returns. I mean, you're doubling them minus the interest rate that you have to pay on the loan that you're taking out. But so you're not purely doubling, but you're double dipping. So you're basically using the same money to invest in 1, 2, 3 multiple assets. So the reason this works is that I borrowed against my share of Apple and I invest in a real estate fund, or maybe I go out and buy a real estate property. Maybe I used $100,000 to do that. I've now got that $100,000 being put to work in 2 different ways. And so I'm basically double dipping and not doubling my returns in a true way, but I'm amplifying my returns. And you're coming close. I mean, when I looked at this a couple years ago, when interest rates were very low, you could borrow at low 1%. So I know, 1.5% at one point. So you're coming close when you factor in the tax deduction, which I'll talk about, to doubling that. So double dipping, doubling up on your returns. And lastly, whereas before you pay tax when you sell the share, here you actually get a tax benefit because you should get a tax deduction for the interest that you pay. So when I borrow against my Apple share, I have to pay interest to the bank on that, and that should be low. It should be very competitive. It should be lower than what mortgage rates are available at too. It should be, and I've never seen it not be the lowest rate at which I could borrow when I'm borrowing against my public securities in my brokerage account. Certainly not with the bank I use, but I get a tax deduction for the interest. So I have a lot of people come to me, when interest rates were high, and they said, well, my SB lock is now 5%. And I thought, well, it's not 5%. That's actually pre-tax. So it's actually a lot less when you tax affect that deduction, because while you're paying 5% interest to the bank, you get a tax deduction for that interest, assuming you use this strategy right and use it for investment purposes. And so if I take a loan against my Apple shares and I invest in buying real estate, I can use the interest I pay on those Apple shares to the bank as a tax deduction for my real estate investment, because I borrowed again from myself to fund another investment. So if I go out and buy a rental property from a bank and I take out a mortgage, then I get to deduct that interest I pay to the bank. Well, here you get to deduct that interest that you pay to yourself, and you basically are your own bank. So if you've ever heard of the concept of be your own bank, this is a way to use this, and you're the bank. And if you use the money that you're borrowing to make investments, or if you use it for business purposes to invest in your business, then you get a tax deduction for that interest that you're paying. So when you see that your rate of borrowing is whatever percent, keep in mind that's the pre-tax, that's not the tax effective number. And when you factor in the tax deduction that you should get, that interest rate should be a lot lower. So you can usually borrow against public securities. That's why I like to use stocks in a brokerage account at a very, very low rate of interest. You would not get the tax deduction for interest if you borrow to fund personal expenses. So when I talk a little bit about like how Jeff Bezos and Elon Musk and them use a strategy, they might not be getting tax deductions because they might be borrowing to fund personal lifestyle expenses. So if I borrow against my Apple shares to pay my rent, which is a strategy that a lot of people use, then I don't necessarily get a tax deduction for that because I'm not using the funds for investment or business purposes. So if you set this up right, and if you're really doing this as an investment strategy tool and not to kind of fund your personal expenses, then you should get a tax deduction for that interest. And, the way the tax deduction works will depend on how exactly you're using the money. But this is something any CPA should understand. If they don't, I would be concerned about that. But you should be able, if you use that money for investment or business purposes, you should be able to deduct that interest on your tax return. So this is how the strategy works. And, practice, if you're using something like a brokerage account, public securities, I personally love to use the strategy that way. It's the way I use it. There's other ways you can use the strategy, but for me, and I think for kind of the common, very savvy investor, this is a great tool. Keep in mind when we're talking about public securities, the loan that you're talking about could be called different things: portfolio line of credit. SB lock is the term I use most frequently, but that just means security-based line of credit. So that can be called a number of things, but just remember, you've got public securities and you're borrowing against those securities. And so it's whatever the loan is called, it's just borrowing against whatever's in your brokerage account. You can also do this against bonds. You can do this against any public securities, but I would be very careful with riskier investments such as like small cap companies, public companies, because those are more volatile. And so, one thing to keep in mind here is that when you take a loan out against your brokerage account or your public securities, there can be what's called a margin call. And that happens when the value of your portfolio drops below a certain amount. So typically you can't borrow more than 50%. So if I have $1 million in my brokerage account, typically you can only borrow up to $500,000. But you need to watch out and make sure you have a cushion, because if the value of your portfolio drops too low, the bank's going to issue what's called a margin call. And when that happens, you either have to pay off a piece of the loan or all of the loan, or you have to put more securities into that account to bolster the value of your portfolio. But essentially, A margin call happens when your portfolio value goes too low as compared to the loan that you're taking. So in my case, I can't borrow more than 50%, but I would never want to borrow more than that. And then I could have a margin call if my portfolio value dropped 75%. So basically, I need to make sure that I maintain the value of my portfolio in a way that I can see exactly, how much cushion I have. And you'll see different things. I actually have a course where I go through in a lot of detail these investment tax strategies that covers buy, borrow, die, where I walk you through exactly, using the bank account, what to watch out for, how to plan for this. But be careful. You don't want a margin call, but if you do have a margin call, it's not the worst thing in the world. You just want to have a plan in place for that. But you don't want to be borrowing, 50% of your portfolio when the stock market is really inflated and really high, because that could come down and you could have a margin call. So be careful when you're borrowing how much you're going to do, and have a plan in place in case there is a margin call in the future. But make sure you understand these terms and what that means. If you don't know what a margin call is or don't understand it, you should. There's plenty of YouTube videos out there on that. But you're going to need to understand that and be prepared for that. But don't let that scare you. I hear a lot of people say, I would never borrow more than 25% of my brokerage account. Well, I don't understand that, because first of all, the stock market does definitely go down. But to me, that's kind of doomsday investing. It's like, oh gosh, what if, the Great Depression or 2008 happened again? And I don't invest with that mindset. I just have a plan in place in case things do get really bad again, because they will. And, that's happened to me before. But having a margin call is not the worst thing. What might happen is, if you can't put more value into your account or put more securities in there to bolster the value, then the bank's going to start selling your securities. So they might sell, your Apple share to get their money back. But if I was going to sell that share anyway a couple years ago, then I don't understand why, selling it 5 years down the road is the worst thing that could happen. I mean, it's not great, because the sell's happening when the value is very low. That you would only have a margin call when there's like a dip in your portfolio. So it's not a great result. But again, I don't personally think a margin call is the end of the world. You've got shares in there, that could be sold if need be in a worst case scenario. You should just have a plan in place to satisfy that margin call for what's going to happen. But again, I wouldn't let that stop me from doing the strategy, but you just need to be careful and understand what you're doing. I do see people get themselves in trouble with the strategy when, for example, I think one of the founders of Peloton got himself in trouble because he had a big SB lock on his Peloton shares. And, we know what happened to Peloton, a few months ago. And so, of course, he had a margin call, and I don't think he could satisfy the margin call because he didn't have other assets or liquidity available. I would not do that. I would not use this strategy to borrow against, a small cap stock or one stock like that. Ideally, you've got a diversified portfolio, and you can borrow against that as a whole. But just be careful with extremely volatile stocks, or assets in general. You wouldn't borrow. I would never, ever, ever do the strategy against cryptocurrency. Maybe 20 years down the road when it's, a lot less volatile. I own a lot of crypto, but I can tell you that's the last asset I would ever borrow against or do this strategy with. So what you can do with crypto is just own the asset and then just never sell it. And maybe in the future, it'll be an asset you could borrow against. But with crypto, instead of, doing it in buy, borrow, die, I just do the buy, die for now. And, your heirs will get the step up in basis in an asset like crypto in the future. So again, this is just the way this strategy could work in practice. Be careful if you're going to do it to have a plan in place. You have to pay the debt. You don't have to pay current principal payments on the loan with a securities-based line of credit. So you don't have to pay back what you borrow on the Apple share, but you do have to pay interest. So just be careful with that. You have to be able to pay the interest. Hopefully you can set this up in a way that your dividends in your brokerage account satisfy the interest. So you're starting to eat a little bit into your outstanding loan over time. But, you're that when you die, there could be an offset, but your heirs are still going to step up in basis in the assets that are left. So again, great strategy. Look at all the benefits. It goes beyond just tax, not paying tax on the gain. But this is the way I use this strategy most commonly. This is the easiest way to do it. This is the way kind of, us average investors out there that aren't Jeff Bezos and Elon Musk do it. So now that we understand how we can do it, I do want to tell you how this strategy is used by billionaires. So I've worked with a lot of, didn't work with Jeff Bezos, but I've worked with a lot of billionaires and really, really uber high net worth people on how to do this. And I want to make sure you understand this isn't going to be as applicable to all of us, but I do want you to understand how those guys do this and gals, how they use this strategy to avoid paying any tax on, these massive accretions of wealth. So this is the way Jeff Bezos did this. And this is the way he continues to do this. So he started Amazon, many years ago. I think, bootstrapped it with some money from his parents at the beginning. And then he built this massive company. We know the story, he's worth billions and billions of dollars. So he got to the point where Amazon was huge, but he never wanted to sell his shares. I don't know that he's ever had sold big chunks of his Amazon shares. We know Elon Musk has started to do that with Tesla, but before that, Elon Musk, didn't sell a lot of his shares. This is a lot of billionaires. You don't hear about them selling their shares for the most part. They might do small shares, but they can't. If Bezos went out and sold all his Amazon shares, it would be a huge impact to the market and the value of Amazon as a stock. So he can't do it, nor would he want to, because he would pay tax. And he would pay a massive tax bill on that. You can read about how Elon Musk sold a bunch of Tesla stock last year, and he is paying the biggest tax bill that's ever been paid in the history of the U.S. So again, you can understand why people like that would not want to sell their shares. So what does he do? So, Bezos is like, I'm worth billions of dollars. I don't want to go sell my shares, but I want to, I want to go out and buy a yacht, or I want to buy a nice house or houses, in his case. So what does he do? Instead of selling his shares, he takes a loan against them. He might do it the way we do it, where he does a portfolio line of credit, but more likely he's going out to some bank or, some lender at his level and borrowing against those shares. And they're happy to lend to him against Amazon. I mean, Amazon as a collateral and a loan would be great. I think most of us would be happy if we ever lent money to have Amazon shares as collateral in case things ever went wrong. But that is how Bezos accessed liquidity against his Amazon stock. So he might, you read stories about, I know Elon Musk has talked about this, like where he was completely broke when he was starting these companies, even though his net worth might be close to $1 billion in the past. And now they don't necessarily have a ton of liquidity because Amazon's not making a lot of dividend distributions, and they don't get paid high salaries because that's terribly taxed. They don't want high salaries. So the vast majority, probably 99% of their net worth is tied up in these company shares. So what they do is they take a loan against them, and they might use that loan to pay their rent. They might, if they're smart, which I'm sure they're doing, they're using loans to start investing in other things, because even Jeff Bezos would not want, 99% of his net worth in Amazon shares. He'd want to start diversifying. So he can't do that unless he's able to access liquidity against his company. So what he does is he takes a loan against the Amazon shares, and he might go out and invest in, syndications, hedge funds, anything out there to start diversifying the assets that he owns, because he doesn't want the only asset he owned to essentially be Amazon shares. And the beauty of what's going to happen to him is that when he does die and passes those Amazon shares on to his heirs or whoever he passes that to when he dies, then they get a step up in basis. So let's say, for example, Bezos has $1 billion worth of shares in Amazon. It's quite likely his taxable gain, if he sold those, is $1 billion, because he probably doesn't have much basis, if any, in those shares. That's just the nature when you start a company and that company just explodes in value. So he could either pay tax on $1 billion of gain, which would be a massive tax bill, or he can pass those $1 billion of shares on to his heirs upon death. They can turn around and sell those Amazon shares that day, and they don't pay any tax. So you can see why this strategy is huge for people like Jeff Bezos, Elon Musk, other billionaires, or just high net worth people that build these massive companies that just explode in value. They can basically do this in a way that they never pay tax. So Jeff Bezos pays tax on any salary he gets from Amazon, which at this point is probably virtually very low compared to what he's worth. He doesn't pay tax on the Amazon shares himself because he's never going to sell them. And his heirs can turn around and sell them when he dies, and they don't pay any tax either. So he effectively passed on $1 billion of net worth to his heirs with no tax applying. And so here I'm talking about income tax. Estate tax is something separate. So keep that in mind. We're only talking about income tax here, but that is huge. You cannot beat that from a tax planning standpoint. You just built $1 billion of net worth. You pass on to your heirs and nobody paid any income tax on that. So that is why this strategy is so powerful. And yes, most of us aren't Jeff Bezos and we're not able to pass on $1 billion tax free, but we could pass on a lot. I mean, we could pass on millions and millions of dollars without our heirs or anyone in the process having to pay that 24+% tax on that gain. So I know this isn't relevant to a lot of us, but I want to make sure you understand how these people are using this strategy. And just so you can see exactly how powerful this can really be. And similar to the example before, the benefits is Bezos is still getting future appreciation in Amazon, which if he had sold those shares 20 years or 15 years ago, think about all the appreciation and value he would have lost. He's not paying any tax on the gain. He can diversify his investments by borrowing against his Amazon shares, invest in whatever he wants. He can double his returns by investing in other assets. And assuming he uses the money that he borrows for investment or business purposes, maybe he wants to go fund his rocket ship business, he can take a tax deduction for that interest. So the benefits are beyond just avoiding the tax on the gain. It's a huge, very powerful strategy. And so this is how it's done in practice by the Bezoses of the world. So, now that we understand how Bezos could do that with respect to Amazon, let's just see how this could work for us that, are business owners or start a business. So let's say I start my own business and that business is very profitable. I built it up. Maybe it's not worth what Amazon is worth, but it's worth several $1 million, even though it's still a small business. Let's say the value of that business, I started it with, a little bit of money on my own, and now it's worth $10 million. So let's say I invested everything I had in that business and I don't really own any other assets. And this is not an uncommon fact pattern. You might have business owners who have businesses worth $5, $10+ million, and that's the only asset they own. So that is very risky and dangerous for a number of reasons. But, they can't do anything about it. That, you hear a lot of the wealthiest people might have no liquidity. One thing I learned when I started really understanding how to invest my money is that you feel poor because you don't have liquidity. And so you don't have a lot of cash. Like your checking account might show very little cash because of the way you invest and the way you have every dime you have put to work investing for you. And so I'm a business owner. Let's say I started my business and now it's worth $10 million. But I'm thinking, oh no, I need to start diversifying. This is, what if something happens to my business and I lose it tomorrow? I don't want all my money to go away. So I can take a business loan against that business. It's not going to be the same way Jeff Bezos can take a loan against Amazon, but there are people who will lend against your business. Like, yes, you probably have to have a bigger business. You're probably not going to get a business loan if your business is only worth like $1 million or so. But when you start to build a business worth 10 million plus, you should explore every avenue to get lending for that. You could get loans against if you're a business that has inventory, for example. If you're a business that has real estate that you own, take out as much debt as you can against that and find ways to borrow against your business and the business's assets so that you can take that money and diversify it and invest in other things. You might want to go buy Apple shares. Then you might want to go buy real estate. You want to start diversifying, but you don't want to sell your business. This is a lot easier to understand, I think, as business owners. The last thing we want to do is sell our business unless we're just trying to exit. I would never want to sell 20% of my business and have some minority business owner that is bothering me, asking, a lot of questions and trying to dictate how I run my business. So we need liquidity. We don't want to sell. Selling is usually not an option until we're ready to exit. So take out a loan, explore every avenue to borrow against your business. There's somehow, we have this misconception that debt is bad. I know a lot of like the Dave Ramseys out there have perpetuated that idea that you should pay off debt, pay off your mortgage as quickly as possible. Well, I think now we know that's wrong, and that if we understand how to use debt and how to differentiate between good debt and bad debt, debt is one of the best tools from a tax planning and from an investment standpoint. You cannot build significant sums of wealth without employing good debt. I rarely see it done. When I have seen it done, it's been a very painful process for the person. They've probably had to, work it some company for their entire life and have a miserable life, making a high salary or something. If you want to build wealth and you want to do it in a way that you're achieving financial freedom and you're not just killing yourself every day, you are going to have to understand what good debt is, and you're going to have to understand how to use it. And one of the best ways is to borrow against your assets. That is good debt. I talk a lot about it in my other videos, good debt versus bad debt. But we are talking about borrowing against assets, and what better asset to borrow against than our business and our business's assets. So use this strategy, start a business, take out a loan against that business, start to invest that in other uncorrelated assets. If you want to, pass your business on to your kids at death. They get a step up in basis. It works the same way it works for Bezos. It's just a little bit different how we employ this, and the numbers are obviously probably not as high, but you can still use this strategy. There's no reason why it's not available to you and your business. Maybe if you don't want to own your business and pass it down, then that, you wouldn't put it in this wheel, but you could still do step 1 and 2 and just sell it in the future. That's still better, obviously, and it still allows you to get some liquidity and start to diversify. But if you do pass it down to your heirs, so it's a family run business, you can avoid paying any tax on that. Same way it works. You can pass the total value of the business without paying any income tax on that. So that's basically an overview of how the buy, borrow, die strategy works in practice. If you understand it, you can understand how to start doing this strategy yourself, but be careful. Don't listen to people when they say it's too risky. Don't do it. Everyone, that really knows what they're doing and understands the strategy is able to do this in a way that it's not risky. And it's not risky in a bad sense. Of course, anytime you invest, there's risk you take on. Anytime you start a business, there's risk. But, I think we understand that if you're just not willing to take on any risk, then you're probably not ever going to, be able to build wealth. So understand what you're doing. Have a plan in place. You have to be able to pay off the debt. You have to be able to have the money in place to service the debt. If you're borrowing against your business, you will have to pay principal. So, the business needs to have the cash flow to pay off the debt. You can't just go borrow if your business isn't making cash and can't pay the debt. That wouldn't be very smart. But understand how you're going to pay off the debt. Understand if you're going to borrow against public securities, what a margin call is, what your plan is for that. And be careful, don't go out and borrow 50% of your portfolio when the market is just crazy inflated and high and likely to come down from that. Just be reasonable, understand the strategy, understand the benefits and what we're trying to achieve here. But again, this is one of the best tax planning strategies out there if you can understand it and employ it. And it's available to all of us. It doesn't matter how much money you have. It just matters that you understand what you're doing. So hopefully you found this video helpful. If you did, please like and subscribe to our channel.